G'day expats, ladies and gentlemen. As always, welcome to another episode. I'm joined with my co-host, Jeremy Harper. Good morning, mate. How are you?
Morning, James. Very well, thank you. Very well. It's still some really good weather here in Sydney, so I can't complain.
Oh, mate, jealous. The Gold Coast has had some absolute shit weather the last, what seems like the last 2 weeks, and it just keeps raining every other day. So hopefully it stops very soon. We love coming into these cooler months and these winter mornings that we'll start to get in a couple of months, but it starts to get really crisp when you look at the ocean and the morning sunrise. It's really nice because of these southerlies that come through, but we're just not really getting it at the moment, which is a shame. But mate, I want to pin you aside, pull you aside, talk about the recent inflation data that's just popped out. It's a bit scary, but I think it was expected.
Yes, it was. So we are recording this on the 30th of April.
Yep.
So hot off the press, we had the March 26 CPI print, which came out yesterday. And if we
Yep.
look at the headline inflation, it's running at 4.6% annually. So well above the RBA's target of that 2 to 3%. But then if we
Yep.
look at the trim mean of it's running at 3.3%, which is stripping out a lot of those shocks from the fuel.
Yeah, it's just too high. It really is. I feel like on previous episodes we talked about where it was going to go. We made some predictions off the back of the Middle East. Remember this March quarter output, it captures obviously January, February, and March, but the really meaty inflation parts didn't come until that last month of the quarter, being March.
Mm.
Inflation was already somewhat tracking in a, like, I suppose, a hiking way. It was increasing and it was starting to run away. We heard Jim Chalmers talk about it late last year as well. So it was starting to get embedded, and therefore this recent spike caused by the Middle East has definitely pushed it over the edge. What were some of the things that really sort of made it jump for the quarter?
Yeah, so transport now 8.9%. So if we look at, as you said, the monthly for fuel, that increased for the month at 32.8%. So huge increase. That
Wow.
that
Yeah.
that
Yep.
higher petrol prices come through that print very quickly.
Mm.
And then housing 6.5%, rents 3.7%, and clothing up another 7%. So I think the challenge is going to be now that fuel has obviously the fuel's come off with that rebate. So we'll see a
Yep.
little bit of relief there, but we're going to see some of these other sectors, housing and these other groups still have a high print because a lot of those suppliers will be passing on those fuel surcharges. So that's still to flow through in this data.
Yeah, it is. I think this is something that will flow through the system definitely for the next couple of months. You're right. Like we've got a bit of reprieve there, that fuel excise. Government seems pretty transparent about what the fuel supplies are as well in Australia. It seems like that hasn't really changed too much. We've still got sort of over 30 days of fuel, and that's what we've always had. And they've shored up those relationships. Obviously, the longer the Middle East conflict goes on, the longer the straits closed, the more exacerbated the world economy comes with the lack of fuel supply to a degree. So it would still be evident that I would say over the next 6 months, fuel prices will keep tacking up,
Mhm.
even though they've obviously actioned that fuel excise. Pretty concerning, that 32.8% spike in March. So hopefully that doesn't continue at all. But I think, yeah, we'll still be paying more for fuel. As you mentioned, that trickles down to other areas, goods. We'll start to see inflation embedded in, your fruit, your groceries. I think when I went to the grocery store on the weekend, I saw that capsicums, they're usually like $6 to $7, $8 per kilo. And then there was some which were like $12. And I was like, what the hell? And I was like, wow, okay, there's inflation for you. That's just due to the Middle East. A bit of short supply there. So one good thing that came out of the inflation print was services inflation.
Mhm.
Last print, it was 3.9%. That's actually come back to 3.6%. So that's really good. Hopefully we see that trend continue. I guess the trend mean being 3.3%, 0.8% for the quarter. So not massive, which is good. That takes out those volatile items. Still too high though, 2 to 3%. So what are we thinking the RBA is going to do next week when they meet?
Yeah, so they meet on Tuesday. The market's got about 70% probably of
Mm.
another
Yep.
hike this month. And if you see some of the economists, Westpac now is changed their changed their tune slightly. They're now thinking 3 more hikes for the rest of the
Yep.
year.
Yep.
So, and some economists, yeah, are saying perhaps a 5 in the cash rate starting with a 5. So I think,
Yep.
but what will be interesting is the meeting, it obviously comes through next Tuesday, so the 5th, and then we've got the budget on the 12th. So it's going to be
Yep.
a jam-packed May. And I think for me, what I'm really interested in, and I don't think I'll see it, but obviously with the budget, there's been a lot of talk around what's going to happen with capital gains, what's going to happen potentially negative gearing. We'll talk about capital gains earlier. Doesn't seem like it's going to be that much of a material impact. But from the inflation side, are we going to see the government make some material changes to expenditure? Because we do know that in that print, so much of that inflation is coming from the
Government.
government. Are we going to
Yep.
see some pullback, or are we going to say, well, we're going to review the NDIS again and potentially, make changes on the edge, or are we actually going to see something significant where they can take some of that pressure out of the system?
Yeah, I mean, government spending's been ridiculous, to be honest. That's where so much demand's coming from. So they've been a big contributor to inflation. But you're right about May being just jam-packed. I think they're going to default to the old indexation model for capital gains.
Hmm.
Not sure how they'll apply that to share assets. If it's going to be broad-based, I'll have to wait and see on that one. But definitely going to see a big change. And then whether they apply the negative gearing principles to just 2 investment properties per person, that's another one that a lot of investors will be watching closely. Can certainly take the shine off running a negative geared strategy or property investment strategy. So maybe you'll see more money start to climb into shares if they obviously define it as per the asset class.
Yep.
So keen to see what that looks like. The budget will need to be relatively friendly as well, because inflation's so high. They can't really give us too many freebies. They might play with some tax rates again, individual tax rates, and maybe do some more tax cuts or propose some more tax cuts, which might not happen for a few years anyway. So not sure how that's going to help the economy. It's anyone's guess. I think the interest rates will need to keep going up. I think I agree with what your comments there. I know some chief economists are saying that interest rates need to go back up with a 5 in front of it. So that would mean if we got 0.25 next week, that'd sit at 4.35. So we'd need at least another 3 increases to get it above with 5. So I think that could be likely. I just think the only place it's going this year is definitely up. And then it might settle next year, and then we might not see a rate cut until maybe the back end of next year once this inflation's tackled, just because we can't let it become systemic and ingrained in day-to-day living, because the flow-on impact of that is just ridiculous. It causes this cycle. Michelle Bullock talked about it actually in the last RBA meeting and a really good example is what we've just seen recently with the Middle East conflict. So with the Middle East conflict, we had people rocking up to fuel stations and essentially hoarding fuel, filling up their jerry cans. So with that, it increased demand, which obviously increased prices. But when you've got high inflation and that becomes ingrained in our own thought process, you just constantly have that happening when people are going for their groceries rather than getting their normal groceries, they stop up and get a little bit more of something,
Mm.
which means the demand goes up, which means the inflation goes up and so on and so forth. So we can't let that get ingrained in day-to-day society. Otherwise, inflation just runs away from us. And then again, the RBA has the one blunt tool,
Yep.
go up with interest rates, cause a bit of pain in the economy, and then, gets a handle on it. So just got to be very mindful of that and see where they take us.
Yeah, I just hindsight, but I look back now, those cuts that they put through in 2025, it's becoming very clear that that was political
Yep.
around election, and it's becoming very clear that that was the wrong way to look at
Move.
the policy. And I just
Yep.
kind of think now, if they held rates where it was for the last sort of 12, 18 months, where would inflation be today? And would
Yeah.
we be having
Oh,
some of these shocks? And would we be better prepared to actually tackle what's happening from the Middle East?
yeah. Oh, I agree. I think you've hit it on the head there. If they just kept it where it was, the economy wouldn't have grown as aggressive as probably what it did in the December quarter last year, but the economy would be better prepared for what's about to happen and what we're about to
Mm.
go through for the next 6 months. But I think it was political. Definitely won some votes, even though the the government doesn't really have any say, but definitely political. What are the big four banks saying at the moment in terms of forecasting?
Yeah, so a lot of them are expecting another hike in May. Westpac potentially three more. So they're
Yep.
predicting May, June, and August. And then, yeah, CBA and NAB well, CBA is saying it's a possible hike in May. I don't think it's guaranteed.
Hmm.
I think they've got their unemployment peaking a little bit higher than some of the other banks. And then NAB's expecting it as well.
Yep. Yep. And then what's that sort of translating to in terms of borrowing and expats borrowing and even down to like what it means for their repayments?
Yeah, so on a $1 million loan, every time there's a hike at 25 points, adding sort of $150 on that repayment at P&I.
Yep.
So in isolation, it's not material, but if you've got sort of say two or three hikes, that's nearly $500 extra per month. So that's sort of
Yep.
$6,000 you've just got to find in that 12-month period, which it's not nothing.
No, it's not. And I mean, the big question that we often get is it too late to fix now, given that on the rate hiking cycle we're still going through? If we get another two or three, should have fixed rates been done at the start of the year or last year, given that a lot of the fixed rates are sort of that 1 to 3 year period. So
Yep.
if rates go up this year, but then they come back down, you're still locked into a fixed rate. So you could be still paying a premium for another year or two.
Correct. Yeah. So I mean, variable at the moment for owner occupier, probably around that sort of 5.7 to 5.9 range.
Yep.
Now the fixed rates have increased significantly over the last sort of 3-4 months, particularly just before Christmas. They started this cycle. So now you'd be locking a 3-year fix at sort of 6.5%. So you'd be taking substantial, 60, 70 points. You'd be locking a high interest rate.
Yep. Yep. Paying a premium. I mean, I know a lot of clients right now are just riding the wave, the variable wave, because
Yep.
interest rates are going to go up. It's not going to be forever. It's going to be maybe a 12-month period, maybe not, and then it'll come back down, and then everyone will start to see the benefit of the discount again.
Yeah. I was speaking to some expats just this morning and they're on a 30-year fixed at 3.1%.
They're in the US, aren't they?
So $1,200 a month repayment. That's it, locked in for life. And you think, gee, it's not a bad.
It's just such a different banking system over in the
Yeah.
US with those long-term fixed rates. It's just it's remarkable that can be done, to be honest. But then they're in that awkward position where they can't refinance on that loan because then they'll default to the market rate now, which is like 5 or 6 or even it was 7% briefly. So like if they've got equity in that property, which they probably do, they can't go back and pull the equity out because they've got the fixed rate.
Correct.
So
So I have to go
yep.
second.
Yep. Interesting, that one. So big four, like, I mean, what's probably the average big four rate you're seeing at the moment for fixed for 1 year, 3 year and 5 year or even go
Yeah.
1, 2 or 3. Yeah.
One's like around that 6.3, a little bit higher, maybe 6.3, 6.4 on the 2 year, and then that 3 year fixed around that 6.5%.
Yep. Yep. And is there any rates that you're steering people away from? I think there's been some overseas sort of borrow rates that one of the big four banks has put out, which look pretty scary in terms of how much they're charging.
Yeah, I mean, if you for expats specifically to our
Yeah.
audience, you just
Yep.
have to be mindful that some, for example, NAB, they don't really price up lending for overseas borrowers. So you just have to be careful around that. That they
Yep.
might try and charge you just their regular variable rate without any discount applied to it. So you just have to be careful.
Yep. Yep. So yeah, what you see probably on the website where it's 8 or 9%, that's probably what they'll actually charge you on the comparison rate. So yeah, definitely. It's just ridiculous. Actually, it's like a second or a third tier lender, that rate.
Correct. Yep.
Um, and as we turn our focus to more data, labour market, ABS published the March data and that was released only a couple of weeks ago, but that seemed pretty good still, 4.3%. We definitely
Yep.
don't want it tracking up any further. If unemployment has a 5 in front of it, it's usually indicative that we're in recession. So it's higher than what it's been, but it's not high enough to cause concern at the moment.
Yes. I think Westpac, they've still got their forecast at peaking at 5% early next year, and
Yep.
CBA slightly lower at 4.7% at the end of 2027. So,
And I mean, realistically, if interest rates keep going up, like we could see, unemployment hit with a 5% on it because there's just less liquidity in the market, and therefore, less money for businesses. There's probably layoffs. So we might have that period of unemployment being with five in front of it, which, could be a technical recession very briefly for the
Yep.
Australian economy before they start lowering interest rates and it starts gaining momentum again.
Correct. Yep.
Yeah, that's good. How is the property tracking at the moment? We saw that Cotality sort of home values report be spat out only recently. How's it all looking?
Well, I mean, the takeaway, the story is pretty clear. You've got Perth and Brisbane and even Adelaide are driving
Love
the
it.
country.
Yep.
And then you've got Sydney basically not doing a lot. And then Melbourne and Sydney are sort of going backwards, really. So I think that's going to be the case. You'll start to see a bit more weakness in those markets as the rates start to or continue to climb and they start to sit in those markets a bit more.
Yep. And I think Brisbane's a story around the Olympics in the future, infrastructure investment from the state and federal and even local governments. So we know that's going to keep going. Perth can usually follow the commodity cycle, so that's why it's just powering at the moment. Adelaide, I can't speak too much to be honest. I'm wondering whether a lot of investors are turning their focus there because it's better value for money.
Yes, correct. Correct. I think there's what I've seen around Brisbane is the difference this time around is particularly from Melbourne, the money and people are migrating north, which I just don't think we had that previously. So I don't know if this is such a boom cycle or boom bust cycle. It's more, I think it's long term there for Brisbane. There's that talent's moving up there and they seem to be settled and
Yeah.
happy with the Queensland lifestyle.
Yeah, I mean, we're pretty fortunate here, to be honest, with the lifestyle. Weather's usually pretty good right now. It's just terrible. But yeah, I think we will continue it. But I mean, we're not talking like massive growth here. We're not talking 15, 25% year on year capital growth. We're talking, normal numbers, 5 to 8% steady growth. I mean, steady growth is all you really need in the property market because a lot of the time when you're buying property, you're gearing it with a loan. So
Yes.
if it's doing 5 to 8%, then what you're getting as a return on your actual money that you put down, your deposit is killing it. It's compounded by the gearing effect. It's 2xing or it's 3xing that money that you put down each year, which is great. Bit of Q&A time now from some
Yes.
questions. I've got these couple that I'm going to read out and then there's a few more that we've got sent in as well that we've summarized here. So I'll start with mine. I'm wanting to live overseas. I have a PPOR, so a main residence, but what do I need to do with my Aussie home loan? Question
Hmm.
one. Do I need to tell the bank I'm going overseas? Question two. Or do I need to do anything to rent it out? Question three. What happens if I'm away? So there's a bit of a loaded question there with a lot of questions, but what would they need to do with their Aussie home loan initially? Do they do anything?
I mean, you can do nothing. You can update the bank and tell, if it's an owner-occupier home loan, you can update them and say it's now investment and they'll change the loan purpose potentially and charge you investment rates, which will be higher.
Yeah, don't do that.
If you fixed the loan before you left and you're on some sort
Oh,
of
yep.
low rate, then you can't do anything and half your luck. You just sit
Yep.
on that for now. In terms of what you'd probably want to flag is just, do you need to update your state revenue office around the purpose of the property? And
Yep.
is that going to have an impact for land tax purposes?
Yeah, good one. Yeah, yeah. There's been a lot. We talked about it recently when we were in Singapore and doing our
Yep.
masterclass where the land tax is certainly the sleeper, depending on the state in which you own property, because people are forgetting to uh, I guess, voluntary disclose to the Office of State Revenue that it's no longer a main residence. It's a investment. And that sort of wording and definition is different to the sort of federal stuff where it's the ATO definition of a main residence and you're getting the main residence exemption. They operate very differently.
Hmm.
If you are renting out your former main residence and it's in Melbourne, you actually need to tell the Office of State Revenue within 12 months because you might have to pay some land tax. But if you don't tell them, that land tax can compound and then they'll charge interest on it as well. And you don't want that happening. So being very mindful of that, that's a great pickup. Do I need to do anything around renting it out? Well, we just talked about that. Not really. Get it rented, get it earning some money for you.
Yep.
What happens if I'm away?
The only thing I'd also note, it's probably just being a bit over the top, but maybe just check with your insurer. If it's a freestanding property, is that policy that you currently got whilst you're occupying the property. If you change the purpose, just making sure your insurance still covers that.
Yep. Yep. Good one. And then extending that, get some tenant insurance maybe as well from like your Terry
Correct.
Shears and those sort of things.
Yep,
Because like
definitely.
your home insurance probably won't cover you on tenant damage.
Correct. Yep.
So great pickup there. Next question here. Working overseas, how does HECS impact my lending if I don't live in Australia anymore?
Yeah, good question. So some people I've been speaking to this week actually, and they're like they've got a HEX debt, they're overseas, they're earning income, and they're just not filing their tax returns.
Yep.
Which I advise them that you're going to if you settle on an Australian property, you have to start to lodge Australian tax returns. So your HEX will
Yep.
start to get wrapped into that. So if you're
Yep.
over the repayment rate, you'll have to pay that back. They made those changes around worldwide income, I think a number of years ago now. It's been for quite some time.
Yep.
But from a lending point of view, yes, if you're over the repayment rate, which I think is at 55,000,
I think it's 45,000 now. I think it's
45,
dropped. Yeah. And it's a percentage of your income. People think it's a percentage of your HECS debt. It's a percentage of your income that you have to repay on the
correct.
HECS debt.
Some of the banks, well, a lot of them, if you're looking to lend and borrow to buy investment property, they'll also wrap in the rental income as part of that
Yep.
calculation. So you
Yep.
might think you sit under it, you get a property and it's going to rent out for 25,000 per year. That gets wrapped into that calculation. And then that, as you said, that repayment rate will get impacted. So it'll get factored in as basically like a repayment when we look at your borrowing capacity.
Yep.
Now, there's a couple
Exactly
of
right.
banks that have some caveats around, okay, well, if you can demonstrate it's going to get paid out in the short term, next sort of 2 or 3 years, they can exclude that from servicing. But if it's a chunky debt that's going to be around for a while, it will get factored in.
Alrighty, next question here. CPI hit 4.6%. Should I lock in a fixed rate before May 5th?
Yeah, well, this is what we were talking about earlier. I think just to kind of rerun what we were saying before, rates have already have gone up on the fixed. So, if you're looking at today, you just have to make that judgment call yourself. Are you happy to pay a high interest rate for certainty in the future?
Yeah, it's a tough one. I mean, not recommending anyone walk into fix yet. Just ride the variable wave because if interest rates come down next year, you're still going to be paying a premium for another 18 months,
Yep.
which you won't be happy about. Another question here. I'm in Singapore earning Singapore dollars. Oh, hopefully they came to our masterclass. With CPI this high and another hike likely, is now the wrong time to buy in Australia?
The wrong time? No, I mean, if you can
Perfect
afford
time.
it, if you've got the borrowing capacity coming from Singapore,
Yep.
then yeah, I'd be looking at this market because it's a buyer's market now. It's turned,
Yep.
and that may only last for say the next 6 months, maybe
Yep.
early next year. It may
Yep.
flip again, and
Yep.
so any sort of high interest rate that may cost you, even with a 50-point increase, it may cost you an extra say $5,000 per year. Do you think in a buyer's market you can make that back on the purchase price?
Mm,
Probably.
yeah. Yeah.
Particularly if
Like
it's a good quality asset, you may be able to, if you're taking 5 or 10% off a $1.2 million property,
Yep.
there's some significant savings.
Yeah, and there's certainly a bit of fear and anxiety in the market right now around property or investing in general. And when you have that kind of fear and anxiety, that's like usually the perfect time to actually invest because a lot of people aren't. And then they're only going to look at investing when interest rates come back down. But that's where markets lift and they become a lot more competitive to try and enter the market. Usually you're paying a premium then. So now this year, perfect time to invest. Absolutely.
Yep.
Last question here. If rates hit 4.85%, what will my repayments look like on a $1 million loan?
$1 million loan. Sure. So like, let's take an example. Let's say you're paying like say 6.3% on that current facility. Repayments about 6,200 per month. If that goes up to 7%, because with a variable rate that gets passed on, that's going to take that up to about 6,650. So another 450 a month.
Yep. Yep. So a lot when you think about after-tax income, to be honest, 450.
Yep.
So that's when we'll definitely see a bit of pain in the market and then there'll be less interested investors. First home buyers, they'll probably set back a bit and not look at buying anything because of the fear factor, and then
Yep.
we'll see what happens. That won't last forever though. Those sort of periods where you've got interest rates floating around there, that doesn't last years. That's sort of something that'll last maybe up to 12 months, and then inflation comes off pretty aggressively, and then rates come off as well. That's what we've seen time and time again.
Yep.
That was good. Bit of housekeeping as we wind up today's episode. We've got the budget webinars forthcoming. So we'll be unpacking what is spat out of the budget. Obviously, a lot of concerns around what's going to happen to CGT discount, whether we're moving to that indexation model. There's also talk about changes to trust distributions. There's also talks about reducing the amount of investment properties you can have for negative gearing benefits. So we'll be unpacking a lot of that later in the month of May, around the 20th, 21st. So if you are interested, check in the show notes. We'll have some links there to register for those. And anyone that does register, you are automatically going to get a copy of the slides as well. So that's important. In the meantime, that'll do us for today. Thanks for tuning in, and thanks for your time, Jeremy.
Thanks, James. Thanks, guys.